Exchange rates and interest rates are important for macroeconomic decision making. How does an increase in Japan's government budget deficit affect each of the following? The real interest rate in the short run in Japan, private domestic investment in plant and equipment in Japan. The real interest rate in the short run in Japan. A budget deficit occurs when government spending is greater than a nation's tax revenue. This is the result of expansionary fiscal policy. Aggregate demand is shifting to the right, which results in the money demand curve shifting to the right, and this will increase interest rates. This will also increase the demand for loanable funds. The budget deficit in Japan would result in more government borrowing in the Japanese loanable funds market, and therefore resulting in higher real interest rates. Private domestic investment in plant and equipment in Japan. The increase in the real interest rate will decrease private domestic investment in plant and equipment, making Japanese citizens less productive and decrease economic growth. Draw a correctly labeled graph of the foreign exchange market for the euro and show the effect of the increase in real interest rate in Japan on each of the following: supply of euros, yen price of the euro. The supply curve of euros shifts to the right and the yen price of the euro decreases. If Japan's currency, the yen, is appreciating, the euro is depreciating. It will take more euros to buy 1 yen. This will result in an increase in the supply of euros. The higher real interest rate in Japan would attract more financial investment for Japanese bonds and CDs because they have a higher rate of return. Europeans would have to supply euros for yen to purchase the Japanese bonds and CDs, which would increase the supply of euros. So they will buy yen and sell euros. To reverse the change in the yen price of the euro, should the European Central Bank buy or sell euros in the foreign exchange market? The European Central Bank should buy euros. To add value or strengthen the weaker euro, the European Bank would want to decrease the supply of euros. This would raise the interest rates and appreciate the euro. The European Central Bank should buy euros, their own currency, instead of buying yen. They had to increase the supply of euros to buy yen, and the opposite of that would be to decrease the supply of euros and not yen. So the supply will shift back to the left, and as the euro is more demanded, the demand curve will shift to the right.